All right, folks, welcome to Investing for Beginners podcast. Today, we're going to have a fun show. I always say that, but today we really are going to have a fun show. Today, we have Daniel from the All-in-One Investing platform. He's also on Twitter and LinkedIn. And frankly, he's one of my favorite follows. And smart guy, lots of great insights, and we're going to have a fun conversation today. So, Daniel, welcome to the show, and thanks for joining us today.
Yeah, well, thanks for the intro and thanks for having me, and welcome to all the listeners. I hope I can provide at least some value today.
Oh yeah, you definitely will. Yep, yeah, absolutely you will. So I guess let's start with an easy one. So why
Mhm.
why do you invest in stocks? We have so many choices to invest in: gold, Bitcoin, oil, bonds, real
Yeah.
estate. Why did you choose stocks? What about them get you excited?
Well, I would say it was the naive thought of getting rich and kind of having the idea, you know what, the best way to get rich is probably not doing any work and just spending money and basically making more money off it.
Mhm.
Unfortunately, pretty soon this idea will get cracked by the market the first time you realize, oh, it might not be that easy. No, but I think it's actually most people get into the market, especially if they get into the market young, with the kind of naive thought of, just making money. And stocks are probably the asset class where most people feel that's easy to do. Of course, you have these legendary asset classes, put money to gold, gold will always go up and everything like that. But stocks have a certain magic to them, and that magic is also kind of what got me into it. Although I actually started out learning about stocks when a teacher of mine, back when I was in school, talked about ETF investing. So, that's not the idea of getting rich quickly, but I kind of took his idea and advice and said, you know what, maybe it's even more interesting if I could be better than the market. And that's kind of how I started learning about investing more.
Oh, that's awesome. So, do you remember your first investment? Like, what was the first company that you bought?
Well, my first investments, fortunately, I bought all of them in the COVID era. So after the stock market crash, while COVID hit, I bought almost all of my stocks. I made a lot of money in terms of pretty good returns, although I bought terrible stocks. I don't remember all the names because I bought a lot of biochemistry stocks and all of that stuff. I also bought the big names, of course. I mean, if you build a portfolio and you're just starting out, Apple has to be in there.
Mhm.
Fortunately, I also put Berkshire in there because I did know about Buffett, and I felt like, okay, Berkshire has to be in there. It was actually my best performer for a long time because Berkshire was kind of the stock that I hold the longest in my portfolio, and was also the biggest position because fortunately I was stupid enough to invest in all kinds of weird stocks, but I was not stupid enough to think that I'm some kind of a magic wizard and I know exactly what's happening. So all the weird positions that were definitely mistakes, although the returns were quite okay, were small positions. And my major position was Berkshire and was the only one I actually held. So I would like to say I started out with investing with Buffett.
Yeah, wouldn't we all? That's awesome.
Yeah.
So I guess what was the impetus or what was the turning point that made you realize, okay, Berkshire is the one that I think is going to go do well and the other ones are not? Like what
Mhm.
prompted you to go, okay, I need to dig deeper here?
Well, actually, it's all about studying, right? I mean, beforehand, I did know a bit about stocks. I listened to occasional Buffett interviews on YouTube, but that was it. And then at some point, I was like, okay, now I got to dig deeper. I got to start actually reading the books that you have to read. That was also another mistake I did. The first book I read, I don't know if you also read it, was Security Analysis.
So that was your
And
first one?
exactly, that's the reaction I hope for. That was my first book, and I didn't understand a
So
thing of what they
investing,
said.
thank God.
Yes, because I just went to the library and I was like, okay, I gotta know something about investing, and I just looked for books that had investing on them on or security analysis. It just sounded good to me, so I took it home. I started reading it, and I pretended to myself, no, no, I do get what they say here, although I had no idea what they were saying. Fortunately, it didn't stop me from going further into the space. I ended up reading The Intelligent Investor, which I think is a great book. I know that whenever I write about it today, many people tell me, well, it's boring. All the ideas are old. They are not applicable today. And I don't agree with that. First of all, I didn't think it was boring. I thought it was a good book. And of course, while some examples maybe not be applicable in today's markets, I think it's more about the philosophy. I think intelligent investing for me, it is value investing. So shout out to Benjamin Graham for saying, intelligent investing and then basically portraying value investing philosophy. And I think that's something you can definitely still get from the book. So that was one of the first books. But probably the biggest game changer for me was Peter Lynch's book, One Up on Wall Street, because this was the first book that made me realize you can beat the market and you can do it even as an individual and small investor. And maybe you can even do it because you are an individual and small investor. Because all the big institutions, all the big money managers, they're kind of prone to make the same mistakes as their investors because they need the money from them, right? So that was the first time I thought, okay, it actually makes sense that you have the goal in mind to beat the market, because maybe it's an advantage being a small and individual investor and kind of also being able to invest in all kinds of stocks, right? You do not have billions to manage, so you're not kind of forced to invest into the Apples, the Microsofts of the world. You can go wherever you want to. So I think this kind of revelation was the first time that I, beyond my naivety, thought, okay, there's actually a good chance, or not a good chance, but the possibility that you can beat the market and it can make sense to invest into individual stocks.
Mhm. I agree 100%. And why do you think that the intelligent investor gets such a bad rap now?
I think because it was the first one, the first book on the topic. And when you're the first on the topic, I had seen the same stuff happening to Daniel Kahneman's Thinking
Mhm.
Fast and Slow. When you're the first book in the space and you put all the ideas into that book, then a lot of people will copy many of those ideas and maybe they showcase it in videos, in podcasts, in other formats that are simply more engaging and they seem more interesting. So many people, I think, they heard a lot of the ideas that Benjamin Graham in The Intelligent Investor is telling to them, but they already heard them. So they think, I already know all that stuff. And this book, it's way more boring than the podcast I've listened to yesterday. Right. So
Mhm.
I think that's why many people think the book is outdated and it doesn't say anything new. Because, like I said, Thinking Fast and Slow is the same. I love the book. It might be the best book I've ever read. And so many people say, it doesn't say anything new. It doesn't say anything in a more interesting way than other books. But it's only because it's the first one.
Mhm. Yeah, I agree. I have the Intelligent Investor on audiobook, and I listen
Hmm.
to chapter 8 and 20 every year. In
Yeah.
January, it's a ritual I started many years ago, and I
Hmm.
re-listened to both of those chapters because Buffett has said over and over and over again that those are the two most important chapters in investing, and the idea behind a margin of safety and the idea behind Mr. Market, I think are timeless. And I know that there's a popular meme on Twitter in particular where you see investors throwing their copy of The Intelligent Investor in the trash when they see, some meme stock, going to the moon kind of thing. I always get a chuckle out of it. But I think to really grow your wealth in the market, you have to follow those ideas, and they're timeless ideas.
Yeah. And I think you mentioned those chapters 8 and 20. Those chapters alone, they are they show all of the value investing philosophy, and that's something that will never get old, and that you can also apply to so many different investments. I feel like one thing that many investors, and me included, at the beginning get wrong is that they feel like they need to be in the right companies, and the right companies, they're the Magnificent Seven or the top 20 of the S&P. So you kind of feel the urge of finding the new Apple, the new Microsoft. Maybe nowadays it's more like the new Nvidia.
Mhm.
And I think that's a misconception because almost every stock, or at least there are hundreds, even maybe thousands of stocks that can be great investments at certain times. And if you're focused on 10 of the best companies the world has ever seen and hope to find another company that can compound over decades like those companies, I think you will be unsuccessful because finding those companies will be immensely difficult. And also, if you study those companies and you study what they did, you must come to the conclusion that all of those companies went through phases where they could have gone bankrupt. There was a lot of luck involved. And,
Mhm.
that's what called the survivorship bias. And I do think people should focus more on learning about companies, maybe learning about different industries, and then just tracking them, keeping an eye on them, and see when do they get interesting. When is maybe an hype over? When can I buy into these industries and companies at a cheaper price? When do they deliver more value? And that's kind of what I think more people should focus on going for the new Apple and the new Microsoft.
Mm-hmm. Yeah, exactly. And the other part of that too is if you're looking for the next NVIDIA, for example, you might have to wait 5, 10, 15
Absolutely.
years and think about the opportunity cost of not investing in something else. If you have all that money sitting in a savings account, for example, you're losing money. And even if you just buy an ETF in the S&P 500, you would be better served than just waiting to try to find the next NVIDIA. And I mean, of course, we would all love to find that unicorn, but it's not easy.
Absolutely. And that's a great point, because I mean, there's also the debate on that if you look at the S&P 500 or the NASDAQ and you take the top 5 companies, there's the argument to make that over a 20-year time horizon, mostly those companies change. But what we've seen this time, and I don't want to be the person who says this time it's different, but maybe we should consider exactly like Howard Marks would, he would shake his head about me, but maybe we should consider that a lot of those companies have competitive advantages that other companies never had, because especially those social media companies, for example, they are such a great study basically for how deep a moat can be nowadays. And as you said, if you are waiting for example, the new Facebook or Meta, if you want to call it that now, if you're looking for that, it could take many, many years. And waiting for that, hoping to find those companies, as you said, comes with a lot of opportunity costs, and probably you will not even find it. So I think focusing more on getting to know companies and kind of getting a feeling for how much does this company need to cost so it can become a good investment is way more effective. I mean, every one of us, at least if you dig a bit deeper, I don't know about the listener, but many of us know the study of Monster. So it's a company that doesn't sell any software. It's just a beverage company, and it outperformed Apple by a lot. It outperformed almost every other stock. So oftentimes you do not need to find this new shining NVIDIA company, but just a company that sells at a good price, which can be a boring business.
Mm-hmm. Yeah, exactly. A company that I don't own, but I have followed for a while, is a company called Jack Henry, which is in the banking industry. They basically do the plumbing for banking. They've earned like 18, 20% CAGR over the last 15 years, and nobody knows who it is. And it's unheard of. It's expensive always, of course, but I mean, it's a fantastic business and nobody's ever heard of it. So my friend Peter Sligers from Quality Compounding told me once, there's all roads lead to Rome, and you can find there's a lot of different ways that we can invest to find success. So you mentioned digging a little bit deeper and trying to learn the companies. To you, what does that mean? Like, how do you do that?
Well, I think the most important point is that understand how a company actually makes money. Because if you look, I mean, it sounds simple, but if you look at all these, for example, NVIDIA, I didn't dig deep into NVIDIA, but I think even if I would not get how this company actually works or where the competitive advantages are. Because every one of us knows that Apple makes money because we go to the Apple store and we buy the iPhone there. And that's kind of an easy business. But all of those big businesses, they are so well diversified. They have so many different business segments and so much technology involved that I feel it's very hard to actually understand the business. So when you look at these big stocks, what you mostly do is you take what they report in their earnings, and like an analyst, you try to see how this in 5 years, how does the earnings look, what is or how much value can there be. But I think that's not understanding a business. Understanding a business is knowing what goes into the business. So what do they invest in? And then knowing how could this turn out? So maybe you can go into a business, they're investing in X, Y, Z, and then you can see if this investment turns out well, how much money will they probably turn over? How much money will they make? If it doesn't go well, how much money will they make? And the bigger the company, the harder it is to understand a company like that. So smaller companies, they mostly have one business. And in the earnings calls, in their reports, they will tell you what they invest in and what factors might cause failure, what factors might cause success, and how will this success look and how will this failure look. And I think if you actually want to understand a business, those are things that you should be able to answer. And that's not easy, not easy at all.
Mm-mm. How would you go about doing it if you come across a company? If you throw out, you were talking about some of the biochems that you invested in early on. Like if you come across something like that, and how do you try to determine how the company makes money?
Well, back then I didn't try to determine how the company makes money at all. The first thing you can do is look at the products, right? You have to look at the products. Then you need to look at how do they sell these products and what are the customers. Taking the example of Apple, we are the customer. So there's an end consumer and those are the customers. A lot of other companies, maybe the biochem companies too, they do not necessarily sell to the end customer, but they are customers on the way that they sell to. So you need to understand what are the products they're actually selling, who are the customers they are selling to, and then you need to figure out how much does it cost to produce those products. And also, in the end, what impacts margins? Is that something that can mostly be done in-house? And there's not much, for example, material coming in that an external shock could reduce margins or anything like that. So that's what I mean with you got to dig deep, because it's easy in theory to say what you need to know, but actually getting those informations or that information and knowing how this could play out, that's a very difficult game. And even if I look at the companies I own, for most of the companies, I do not actually know most of these things. You can just try to go as deep as you can and then see, is this enough for me? Does the risks that come from not knowing everything are balanced out by the possible or potential reward?
Yeah. How do you think about, like, let's say you're investigating a company and it passes that first hurdle, like you understand the business and you understand how they make money. When you look at maybe the financials, what are some things that you try to focus on, or you try to look for red flags or green flags?
For me, still the most important thing is the balance sheet, because if there's a company that to me seems in danger of going bankrupt, for example, there's too much debt, there's too little cash, I want to stay away from that, because I just talked about all the factors that you need to look into in the operational space or operational part of the business. But the balance sheet is so kind of dangerous. If there's too little cash and there's too much debt, it can be over with the company pretty soon. So for me, a red flag would be long-term debt is high, cash is low, and a green flag, and that's what I'm looking for, is if I look at the balance sheet, they have a lot of liquid investments or cash, and the long-term debt position is low. That's kind of the first thing that I look at, because if that's not the case, then I would need to understand the business very well to feel safe in that investment.
Yeah. How do you feel about, I love that filter. And one of the things that I've noticed is there are some companies that if you look at their current assets versus their current liabilities to kind of get a sense of their liquidity, but the majority of their assets or current assets is cash. How do you feel about it? Are you okay with that? Is that a red flag? Do you try to kind of account for that?
That totally depends on the company for me. I've seen companies where I would say I love that it is cash, because that's kind of the safest play they can have at the moment. And the business is going well, so they have good returns. For example, they have good returns on capital, then I'm totally okay with it. If you have a company that is or that should be investing into the company because growth is slowing down, margins are getting worse, then of course you feel like there should be less cash on the balance sheet and there should be more investments. So it always depends on the company. What you also see, I came across some investments a couple of years back, and I still look out for not getting back into those, where you see a lot of cash on the balance sheet and it looks great, but they burn through that cash so quickly that 3 quarters afterwards, the cash balance is half of the balance it was before, and the investments are not paying off. So you have low returns on the invested capital, and capital is shrinking significantly faster than, for example, you have modeled. And those are pretty dangerous investments. And there are some of them where, especially if you use a screener and you just put in, like I said, these green flags, a healthy balance sheet, a lot of companies turn up, and I like to say the market is not efficient, but in those situations, sometimes you see it is, because if there's a company that simply looks too good to be true, most of the time it is too good to be true. Maybe they have a lot of cash, but they are one of the companies that are burning through that cash so quickly that you as an investor will never see it.
Yeah, exactly. The reason why I asked that is there's a company that I've owned for a while now, Ajin. They carry a lot of cash on their balance sheet, and I know some of it is customers' money, but a good portion of it is the company's money. And it's not a concern, but it's just something that's kind of been in the back of my mind is they don't buy other companies, they don't pay a dividend, and they don't buy back shares because they don't issue any equity, and which is all great. But at some point, that's going to have to change. And, right now the returns on capital are fantastic. The company is still growing really well. Margins are awesome. All that fun stuff is great. But it's just, it's a tick in the back of my head. Like, okay, is this going to be a problem someday?
Yeah. And I don't know that exact company, but something that you also have to look out for in those cases is that if the business currently is looking great, oftentimes you also have to pay that price. So you have to pay a high price for a business that currently looks great. But you as an investor, how Marx likes to talk about this second level thinking. And this is a great example for that, because second level thinking in this case would be asking yourself, okay, currently it looks great. Currently there's nothing that I need to be worried about, but they have a lot of cash on the balance sheet. As you said, they're not buying back shares, they're not paying a dividend, and they're also not investing. So what's the play here long term? And then we come back to, it depends on the company. In many cases, especially if they're a younger company, it can make sense to invest that capital, especially if you said they have great returns on the invested capital. So if there are other opportunities, other investment opportunities, but they can still have those returns, of course, it would be best to invest. And something that you have to do, and you often can do if you invest in smaller companies, is actually reach out to the management, right? So ask them, why is there so much cash on the balance sheet? Why are you not investing it, although you have great returns? And if there's a good reason for not investing it, how do you think about a dividend, for example? Because that's something you need to look out for, especially if you pay a high price for the stock from the get-go.
You think Peter Vanderdoss is going to take my call if I call him up?
Maybe not in that case.
Probably not. Okay, so I guess kind of speaking of management, how does that play into your investment thesis, or you're developing an idea that you want to invest in?
That also depends. That also depends on the size of the company. So when I did large cap investment, or I'm still in mostly companies that maybe are not large caps, but are mid caps, they have a couple of billion in market cap. In those cases, it's less important to me personally, because I feel like the more diversified a business is, the less big is the impact a single person can have, or even the management team. So, even if there are 3 or 4 people, the impact of them will be smaller. For example, if we talk about the very big companies, the smaller the company gets, the more important the management team gets. Because what they do, what they decide, is going to show in the financials sooner or later. Maybe a couple of examples. Maybe first we start with the big one, which kind of is the opposite what I've said right now, but Nike currently is going through a pretty tough phase. And just recently they changed their management team or their CEO. And usually what I say in that case is, I don't think this will change a lot, because the company is so big, they have so big operations, diversified operations, that I don't think it actually changes a lot if you change the CEO. In that case, though, the person who is going is someone who led the company pretty much like a consultant. And the person who is coming has started at the Nike company as an intern and has spent 3 decades there. So in such a case, I feel like the impact he can have, because of how well he understands the business, can actually be bigger than it usually is at companies with that size. Smaller companies, for example, one company that I hold personally in my portfolio is called Italmobiliare. Probably I mispronounced it terribly because it's Italian. and it's a holding company. So a holding company is also a pretty difficult company to own because most of the time you see a relatively big discount to the net asset value. When I bought this company, for example, it had a discount of about 50%. So if you just look at this from a value investing perspective, you would feel like, wait, if it's a discount of 50%, the margin of safety is huge. There can go nothing wrong with this. If you look at holding companies in general, you will quickly see that they always trade at a discount because the investor is also saying there's one management team, or there's how much impact will it actually have on the businesses? And is the management team making them stronger, or is it making them weaker? And that's why it also often trades at a discount. In this case, with Mobiliare, it is, in my opinion, a management team that is very good at making the businesses stronger than they were before, and especially when they expand. So they're, for example, a company, probably the best company out of their portfolio, which is a perfume distributor and also one of the oldest brands for perfumes there even is. I think that's 100 of years old, also Italian, and it's growing fast. It's growing in the double digits. It has great margins, and the management team basically played a big part in expanding into the Asian market now, also expanding within Europe. So that's an example of where I'd say the management team is important, because if you have a management team in that company that cannot deliver value to the companies they buy, the discount is in fact right. So the market is right there, and then it just will never be a good investment. Maybe Warren Buffett, if I just one last example, is also a good example here, because who would think that Berkshire would have performed the same way if not Buffett and Munger would be at the top, right? And they're also a holding company. So if they do great decisions, or they make great decisions along the way, the company will succeed. If they don't, the company wouldn't have succeeded in the same way it did now. And at the same time, now the company is so big that Buffett himself says, well, he's so limited in what he can actually do that the impact he has as a manager of the company is going down significantly.
Mm-hmm. Yeah, exactly. And I mean, that's one of the big questions, of course, if you own Berkshire Hathaway now, is what's going to happen when Warren's not there. You know, Charlie has already left us, unfortunately, and Warren at some point will as well. What's going to happen to Berkshire? And to your point, because it's gotten so big, he has less and less impact. So hopefully, as Berkshire holders, you know, that it will have less of an impact when he's no longer there.
Mm-hmm. I mean, at least it's a question I ask myself. First of all, how much impact does he currently still have on the new positions that Berkshire is going into? I think on the big ones, probably he's still like the main man saying, we will buy this, we will not buy this. And the smaller positions that you see Berkshire building, let's say the people who will follow. But what will also be interesting to see is how the stock reacts. If there's actually a change in the management team, how will the stock react to those news? Let's hope we will not get the answer to that question for another 20 years.
You're right, exactly. Yeah, that would be nice, wouldn't it? We kind of are talking about like how we analyze stocks and those kinds of ideas. And we've talked about some of the hurdle rates, hurdles to get over, understanding the business, understanding the financials and management. Is there anything else when you're kind of looking at a company that you try to take into consideration before you actually buy the company?
Well, one very important thing is the time horizon I'm planning, because what you can easily do is you analyze a company and you like the company. So you think that maybe there's a great management team, maybe there are a lot of growth opportunities they can invest in. And then you can easily be tricked to thinking, oh, this might be a compounder. And as soon as you think, oh, this might be a compounder, at least that was or has been the case with me, is that I thought, okay, I will just hold this company for quite a while and then see how it turns out. And a lot of times I missed the right point to sell. So the original investment thesis that I had played out pretty good, and the stock went up 40, 50, 60%. But then in my mind, I still had the idea, well, everything is going so well, maybe this will turn into a compounder that I can simply let it like sit in my portfolio. I check the reports that are coming in occasionally, and everything is going well. And most of the time, especially, or once again have to make the distinction, if you're investing into smaller companies, companies will not actually compound that well because they are not diversified enough. They have one business, maybe it's a cyclical business. So your thesis is playing out. There has been maybe a catalyst that worked pretty well, but you missed the point to make the sell. And I feel like that's also something that you can fall into the trap because you're a value investor and you have Buffett in your head and he's saying, the best holding period is forever. But that's actually something he only preaches recently. And recently for Buffett maybe means 30 years, but since he's managing
Right.
many billions. So maybe what I did back then is studying Buffett letters. After I realized this mistake and some others I did, I went back and studied his letters and see how he invested back in the day. And as you probably know, I wouldn't say he was a trader because that wouldn't be fair to Buffett at all. But most of the investments that he made had a time horizon of 2 to 3 years. And if they had a catalyst, maybe even shorter. And I think that's something we all should do more often, that if we have a situation, we are analyzing it and we kind of see why the stocks should go up. Maybe there's a good catalyst. We should also know when to sell. And that never means that you cannot go back to the company at some other point in time. And that's where I go back to my initial point that investments or companies can be good at certain times and can be bad at other times. So maybe you get in at the right time, you bought it for a cheap price, and you participated on the way up. But then it's time to sell. And maybe because you like that company, because it's a good company in general, when it gets cheaper at some other point, you can still get back into it. But thinking that every company is a compounder might make you miss the right moment to sell. So back to the point, you should know how much time do I want to spend in the stock and what needs to happen for me to sell.
Yeah, those are great points. So one comment and then another question kind of along this line. So a few years ago, I was doing some reading about Buffett, and I was writing an article about him investing in American Express. And I mistakenly thought that when he bought it back in the 60s, that he had owned it since then. And I discovered when I was writing the article that he actually bought it and held it for a year or two and then sold it and then bought back in the 90s. And I had no idea. I just assumed because, like you're saying, his mantra is, I like to hold my holding time is forever. I just assumed because he bought Coca-Cola, not too long after, well, it was a few years after that, but he's held it for so long. And I thought American Express was the same way. And it's like, no, actually that wasn't. And so I went back and looked at his early years, and yeah, he was a lot more active when he was younger than he is now. So that was kind of mind blowing for me. So I love that point that you made. I guess the next question then would be, how do you avoid, one of the problems that I struggle with, and I think a lot of investors do, is how do you avoid drinking the Kool-Aid? Like when you do all this work to find a company and you want to hold it forever because that's the mantra that's been burned into our brain, how do you avoid drinking the Kool-Aid and determine, okay, hey, it is time to get out?
Well, the answer is to have a as precise as possible investment thesis. I mean, when I say the answer is, doesn't mean I make it right all the time. Like I said, many of the times I stayed in the stock for too long, and that's kind of only why I have the framework now. But having an investment thesis, which is pretty precise, means that you can write down in 3 or 4 sentences, as Peter Lynch would say, I quote him again, you should be able to explain to a 10-year-old. And that's how you should phrase your investment thesis, saying, why do I actually buy into the stock? So what's maybe also, I know some investors are saying they would never invest without a catalyst. So maybe also include a catalyst. Why do I invest into the stock now? Is there something that's coming up that should bring the stock up? And you should also have a paragraph that says what needs to happen so that I can sell my position, or that I would sell my position. And mostly the number one thing is my thesis is broken. So some of the reasons that you wrote down before, that you said, this is why I'm buying into the company, they are not applying anymore. They are not there anymore. So then you should sell the investment. That's the most obvious reason. And another reason, like I mentioned before, is maybe the stock went up. So maybe you should also have an idea of the fair value of the investment. So maybe that fair value is now reached. And coming back to the point that you made, your example of the company, maybe you do not see going ahead, you do not see how they can still invest at the same returns. Maybe they are simply not investing the money they have. They are not paying a dividend. They're not buying back shares. And if all of that is not creating a new catalyst for more returns, then you should also sell out of the stock. I feel like it's difficult mentally because a company that was such a great performance or had such a great performance for you, selling it always feels kind of bad because you realize gains, you have to pay taxes too. And so you think, well, there's just this bias of saying, maybe they find another great thing, especially if you have a good management team in place. You like to think this, whatever the catalyst was, this has been or this happened. Maybe they find another great thing. So I'm holding on to the stock. I think what we should do way more often is accepting the fact that we had a thesis, it played out, or maybe it didn't play out, and then we have to sell the stock. Like I said, we can still have it on our watch list if we genuinely like the company, but there's a limit to owning the company, and when it is reached, you should go out.
Yeah. Yeah, I like that. How do you think about, I guess, where do you I've been preaching for many years about the idea of notating your idea or why you bought the company or a thesis. How do you do that? Do you have a notebook you do it in? Do you have a spreadsheet you do it in? Like, what is your method of notating that idea?
Yeah, you got me there because I've tried many things. I started out with a notebook because I felt like doing it the old school way, maybe that has some charm to it. Then I felt like, well, the old school way also has disadvantages, which is that you always have to write it down, and if you want to maybe link some ideas or whatever, you have to do it manually, and it's all complicated. So then I start doing it on Excel, and I'm doing it there since then, but I'm not happy with that system. So like I said, you got me there. As soon as I have more time, I need to figure out something else. Or maybe you can tell me. Maybe how do you do it?
Actually, one that I've been using, we interviewed Jake Taylor from the oh God, I'm going to blank on the name of the podcast. Dang it, he does it with Toby Carlisle, and it used to be Bill Brewster. Great podcast. Anyway, we had Jake on the show a while back, and he started a company that actually solves this problem. It's called Journalytic, and it's a free website that you can go and basically do exactly what you're talking about. And you can write down your ideas, you can write down your thesis, you can link to stock prices and all kinds of stuff. And it's a fantastic program. And he's been doing it now for a couple, 2-3 years, I think. But yeah, journalytic.com, it's free. And so it's a fantastic resource. Maybe at some point they might start charging for it, but at this point it's still free. And yeah, I've been a big fan of it ever since he introduced the idea to us.
And now that you say it, I think I've heard the name before, but I've never tried to use it. So maybe that's what I should do now. And free is probably the best investment you can make, right?
Right. Yeah, exactly. Yeah, exactly. All right. So we've talked a lot about like how to find stocks, some of the different ideas and things like that. You started off investing like in Berkshire and other investments, and it sounds like you've kind of changed kind of what you invest in now. So if you had to, air quote, to describe yourself, what label would you put on yourself?
Yeah, that's a difficult one because I'm getting that there's kind of the idea of putting labels on what someone is doing, and it's the best way to get a grasp of what someone is doing quickly. So I get that, but I think it's difficult. What I would say is that in the future, I would like to be labeled as a microcap investor, but I also must admit that I'm currently not there because it takes a lot of time, and especially in the last couple of months and the months to come, I'm lacking the time to do as much of the research that I want to. And in microcap, you simply need to do it because you also need to be on top of the news that are coming out. So in large caps, maybe it isn't that important if you look at the new report today or you do the day after. In microcaps, that's different. Being one of the first people who look at the new reports, who understand them and know what they mean for the stock is pretty important. So it takes a lot more time. So what I just want to say is that I'm not yet there, although I would like to. I'm also not investing into only one or two geographies. So I'm not an investor who says I only invest in the US or I only invest in Europe. So it's also hard to put a label on that. So I don't know. I think I have to go with, and I know that's not a good answer for this, but I have to go with value investor, and then
Okay.
kind of go where the opportunity takes me. That's kind of I cannot narrow it down, unfortunately.
Well, I think that's a great way to narrow it down. And I personally I'm not a big fan of labels. I've never been a big fan of labels. I know people can put a lot of stock in titles and things like that. And I don't care. I know I'm a little different in that respect. I like the fact that you are evolving as an investor, and I think that is probably more important than putting a label like I'm a value investor or I'm a growth investor or we're all investors, and it's just a matter of trying to find what works best for us versus other people. I like the idea that you were talking about or not like, I hadn't thought about the fact that you have to pay more attention to small caps or micro caps than you do.
Yeah.
To your point, you could probably miss the earnings report for Netflix and get to it, 2 months before the next one, a month or a week before the next one's released, and not really miss that much. But I think your point about the micro caps is probably way, way right on the mark.
Yeah, I think one important point there, Greg, that you kind of initiated is that when you said the earnings report for Netflix, I think why you do not need to be the first one looking at it is that I think large cap investing is also mostly a game of opinions. So you do not often have the case that a big company like Netflix is putting out earnings and they are like across the board, they are perfect, or across the board, they are terrible. So, because if they would be across the board terrible, then you should be one of the first people to sell, because I mean, that's a problem probably. But it's just unrealistic that you are in that position on such a big company. And it's also unrealistic that they will post such results. I mean, Netflix is a great example because a couple of years back, they posted results that a lot of the market had the opinion that this is definitely terrible for the business. And some people, I think Bill Ackman was one of them, said, no, wait a minute, this isn't that bad for the business. This is something that they can get over quickly. And this is a great opportunity for me to buy in. And that's something that you often have in large caps. I mean, Alibaba, I've often talked about Alibaba. So that's a similar game, right? If you look at it from a financial perspective, if you look at the balance sheet, if you look at how much money they make in free cash flow, for example, and then you look at the price it's trading for, it's a simple decision. You would say, of course, I buy this company. But then you have the macroeconomic factors that come with it. And those are a matter of opinion. Definitely. Even though I'm long on the company, I have to admit that there are many, many good reasons to not go along that company and to be skeptical about what's happening there. And that's what I mean when I say it's a game of opinion. You hope to be on the right side, but in my opinion, there isn't even a right side. You just hope that whatever comes in the future, however the developments are, they are in your favor. In microcap investing, most of the time, not always, there are also opinions that play a role there, but most of the time, when they put out earnings, it's a sign for, like I said before, is the investment, for example, they currently make, is it going to the right direction? Is it having the returns that you hope for? Or is it going to another direction? Is it a worse investment than you hope for? And that's information that is immediately either thesis breaking or enhancing. So that's why you need to be quick, because most people will have at least somewhat of the same thesis on the company. And if they deliver earnings that show you this thesis might not play out, you have to sell. It's not like in large caps that you can wait, you can take your time, and you be like, maybe this is not as bad as people think, and 3 days later I can buy the stock again with a lot less for a lot less money, right? So mostly it is, if this thesis is broken, it's getting tough for the company and you should get out.
Right.
Maybe a company I can talk about here. I didn't say a lot about it publicly because it was a tiny investment and I saw it more as an experiment, but it was a stock that was discussed a lot on X. I don't know if you know it, but it was Alarum Technologies. It's an Israeli company.
Yeah.
Yes. And it was talked a lot about. And as soon as a lot of people talk about it, I'm getting a bit skeptical, because if it's a small company and you hear from it, for example, on Twitter, and a lot of people saying they own it and everything like that, there's a good chance they also try to pump the stock, right? But it's a great study of how a company or the next earnings is basically make or break, because such companies, they need growth. And this was a company that grew their main product by triple digits the year before. So you knew exactly when the earnings come out, you need a similar result again. Otherwise, the growth thesis is broken. And then you need to get out of the investment, right? So, or at least you have to acknowledge that what you originally thought the company might achieve is not actually happening. And that's a company where you just need to be on the edge. You need to be what's going on. And if you do not have the time to do that, you can quickly be in a company that is going down dramatically. I mean, fortunately, I wasn't in it when it hit the 40s and something like that. But that's also another example, now that we're talking about it, where I should have simply sold when I had a huge profit. Because I think I bought into it, weeks later, it was 80 or 90% up. And those are moments where you might just say, you know what, I should sell this. Because assuming this will become a compounder at this stage where the company is, that's just naive. There's so many years of runway left that they would need to perform consistently, that it's way more, or that it's the way better idea to sell that company when what you hoped would be accomplished was accomplished.
Yeah. Yeah, that's exactly right. And the thing that I've talked to a fair amount of investors over the last few years, and the whole small cap, micro cap thing keeps coming up. And it's something I'm interested in learning more about. And I think my business partner, Andrew, is as well. My struggle with them is that, and this is just, probably more ignorance than anything, is just that I don't feel like there's as much information out there about them. And so I feel like, as somebody that struggles, like I feel like I need to know everything about everything. And so until I do, I don't want to put my mouth out there. It's better for people to think you a fool than open your mouth and remove all doubt kind of idea. And so when I'm thinking about companies like you're talking about, how could I get over that?
I don't think you can. And that's exactly why I didn't. I mean, every listener right now should have reacted the same way when I talked about this company and be like, this is the exact opposite of what you talked about before. Understanding a company, dig deep, because that's what you cannot do in a company like this. We have almost no information how their product actually works. We have very little information on the customers. I mean, I don't want to go into detail now. They just landed a pretty big customer, but every information you have, it's so little. You do not actually understand the business. That's why I said I had a position of maybe 1%. So it wasn't a position where I feel like this is an investment I want to take. It was more of an experiment, like I said, because I'm also new to the space, and sometimes you just need to own stocks to actually get a feeling for what's happening. And this is one of the examples for that. You cannot actually understand this business. And if you are an investor, also like I am, who likes to be concentrated, this is not a company you should own. There's no way. I don't know what information I would need to say I will make this a 10% position and feel comfortable with it. You would need so much more information. You would also need more stability in the business. So just by the logic, the company has to be out still a couple of years and be consistent in what they deliver before you could even think about making this such a big investment. These investments, I think you have to do them as a trade where you have a catalyst, and it's important to have a catalyst in these, and then say, this is the price target that I have. And if we are getting close to this, then I will sell. And if before the price target is reached, we see that the thesis is completely not working out, we have to get out. So I think you cannot buy this company and feel like, is there a way to get all the information that I need? Because there isn't. Also, on this company, I got a lot of comments either from my community or other people who are invested between earnings releases, because the stock was trading. I mean, we talk about a stock that was sometimes like $12, and then it could trade up to $15 or even more without any information. There was nothing happening, or at least you couldn't find anything. So that's a position where you do not want to have a lot of money in, for sure. And I mean, what you can do in the long-term position, and I'm kind of changing topics here, so sorry if that's too far already, but if we talk about trading, because you see a stock kind of trading in a certain range, I did the same for Alibaba, for example, because we talked about opportunity costs, we talked about the game of opinion. And if you look at Alibaba right now, I still think it's a good investment opportunity. But I also know with all the headwinds that you currently have, we just got Trump elected, and we know that his opinion on China will make things a lot more difficult. We also still have the Taiwan situation, and I think no one should sleep on that situation after what we've seen with Russia and the Ukraine.
Mhm.
So, with those things in mind, I do think that we have to at least wait a long time before there can actually be a big breakout. I mean, we've seen one in October. Sometimes it doesn't take that much. But I did say if you have a long-term position, I personally, and I do not say people should generally do this, I do not recommend this, but I sometimes trade long-term positions when I hold them for a long time. Because Alibaba is trading in the same range for such a long time now that I do not know, but I have the feeling if it's close to $70, we're probably close to a bottom. So I might buy a bit more then. And if we go like in October and it reaches $120, I didn't sell anything at 120. I wasn't that good at timing. But if it reaches over $100 and you do not have the feeling that it will break out for good now, it might be also smart to sell a bit of that position. Because if you do not do that, you have to look at the position and feel like it didn't move for 2 years at all. So then the
Right.
opportunity costs, of course, get pretty significant.
Right.
But I would also say to only do this, if you're even trying to do this at all, in long-term positions. Because if you do this and you make it for the short term and the stock is going down and Alibaba hits $70, but then it doesn't stop, but it goes down even more, and it was only supposed to be a short-term trade anyway, well, then you're sitting on a position with a big loss and you cannot get out of it instead of taking that loss. So I just said that's something that I sometimes do, but it's not something that I would recommend or just say, just become traders and forget the long-term position.
Right. That's way, way too hard. That's
Yes,
yeah,
absolutely.
way, way, way too hard. So how do you deal with, you mentioned several times that you've invested in Alibaba and a company in Italy, and that you don't really have a specific geography or geographies you try to stick to. How do you deal with that, I guess, instability or uncertainty? I've invested in Canada, in Europe, in Brazil, and the United States, but China has been for me.
Hmm. Absolutely. And I think that China, especially when I said I want to go more into smaller and micro cap companies, will be one of the geographies I will not participate in anymore. Because if you go into the micro and small cap space in China, there's no information you have anymore. You don't even know if the companies are actually existing, if they actually make the amount of money that they say they are. So the more I narrow down market cap wise, the more I will also have to narrow down geography wise, because you need a way better understanding of how things work. Sometimes you also need to be, or you have to have an idea of the legal proceedings and work in certain countries, because that's a lot more important in smaller companies, because sometimes you simply have things where you have to consider something of the legal stuff behind that. That's something you never, I mean, you don't look at Apple and you feel like, oh, is there something going on the legal side of this? But maybe in microcaps you have to do this. And the more I go into that space, the more I will also have to narrow down on geographies. And if you ask me now, I would probably say I would do North America and Europe. Europe, because I'm German, that's kind of a natural thing for me then. Although maybe Europe is also too broad. Maybe Germany should be the main focus right now, because laws can be totally different in the south of Europe compared to the north of Europe. So especially, I should make the mistake of just putting Europe into one big basket and say it's all the same. So maybe I should focus more on Germany then and on North America, because I still believe that this is a market where you should be in, and especially if you need liquidity. And in microcaps, you often need liquidity, and North America is way better for that. It simply has advantages because the amount of people who invest into the stock market is a lot larger than in Europe or other geographies.
Yeah, exactly. What brokerage do you use to invest globally?
Currently, I use DeGiro, which is a Dutch broker, and Interactive Brokers. I
Okay.
used to be on Third Republic, which is kind of the equivalent of Robinhood, just for
Yeah.
Germany and Europe. But of course, you do not get access to the stocks I'm currently researching there. So those are mostly the brokers that I use.
Okay. You mentioned earlier that you prefer not diversify, concentrated positions or a portfolio. Like
Mhm.
in your ideal world, how many companies would that entail if you had building once your portfolio is air quote built?
Yeah, that's also a good question. In my ideal world, I would say something about 8. There's not a scientific approach for me. I'm just taking, once again, I'm cloning an idea of Joel Greenblatt once saying, after 8 positions, the positive effects of diversifying get significantly lower. There's not much that you can actually, or there's not a lot of benefit that you can have from having more than 8 positions.
Mhm.
But once again, and I know I kind of have to be a person who says it depends a lot of times today, but if I
Part of
invest,
investing.
it is part of investing, yes. If I invest into companies where you do not have as much information as you maybe want to, and you still want to do the investment, maybe not as bad as Alarum, but some other companies that are a lot better, but you still lack some information, then you cannot simply say, well, but I only want 8 positions in my portfolio, so it has to be a 10% position now. You still have to make sense of the company right now and how it fits into your portfolio. So if there's a company that I like to own, but I miss the information that I need to be confident in making this a 10% position or even more, because in an ideal world, I would like to have 2 or 3 positions that make up the entire portfolio. I just know that's a bit too much. So I still have to consider that if there's a company I want to own, but I do not have the information, maybe it's smart to only give it 5% and then see if I can get more information on the way, if I can understand the stock and the company better on the way, and then increase the positioning.
Yeah, I love that. Yeah, there's lots of roads to Rome, and there's lots
Yeah.
of different ways to do it. I don't know if I would have strong enough stomach to have just 8 positions, but to each his
Yeah.
own.
Well, also there's an important point to make and I also point that out to all my readers because I think it's an important thing to say. The factor of age is very, I don't know why, but not many people talk about it. And kind of studying the younger Buffett is also a study of studying the younger Buffett. So he didn't have the same capital because he was younger, and you have a different risk profile at that point. So
Right.
if I go into a position now, and if I'm being honest, I could go into a position now that is 50% of my portfolio. And if I would lose it 3 years from now, after I start working more, after I start earning more money, it won't have any impact on my financials anymore. That's just a fact. So if you are in your 50s and you lose a 50% position, exactly. I mean, that can ruin saving money and investing money for decades, right? So it's a completely different thing. And maybe age is not the most important factor because the number one factor is capital and how much capital you will be able to earn and invest in the future. And if you're a young person and you have most of your money that you can potentially earn in your life still ahead of you, you have a different risk profile than a person who has most of the money that he will make throughout an entire life already behind him. So I think that's a pretty important part of, for example, this discussion about how concentrated is your portfolio. Someone like Manga, for example, who even in his 90s, late 90s, said, well, exactly 4 positions or whatever. I mean, you can do that, but for 99.9% of investors, this is not the way to go. You need to be brilliant. You need to have decades of experience, and you still have to need luck. I mean, Manga was one of the investors, one of the big investors into Alibaba at prices. I mean, even my position in Alibaba, I think I have an average buy-in price of $75 or something like that. Charlie Munger had an average buy-in price of $200 plus. So this has been an investment. I think maybe I'm wrong on that, but it was pretty high compared to today. So this has been an investment that if he would have made this with most of his personal money, for example, or even just a 10% position, it would hurt his performance throughout his entire lifetime by a pretty significant amount. So that's a big difference.
Yes. Yes, it's a very, very big difference. So this has been a lot of fun. This has been a fantastic conversation, and I've learned a lot from you today. Where are you online? Where could people find out more about what you got going on and what you're doing?
Yeah, first of all, thanks for the interview. I enjoyed it very much. And yeah, if anyone wants to read more, I'm on X. I'm also on LinkedIn, but I mostly post on X. And more importantly, I have an investing website, a Substack, which is called the All-in-One Investing Platform. Yeah, you can just check that out. I will post updates on every investment I made. I will post my portfolio. I will give updates on all the positions. And yeah, that's where you can learn more about me.
Yeah. Yeah, and it's I will put all the links to the different resources he was mentioning in the show notes so everybody can find them. And he's well worth a follow. Trust me, he's one of the best follows on Twitter. He puts out these great summaries of books as well as lists of books and lots of great stuff. So he's and he actually responds to you. So he's social on social media. I know it's a shock. So Daniel, thank you very much for your time today. I really enjoyed it, and I know our listeners will as well.
Thank you, Dave. Thanks for having me.
You're welcome. All right, folks. Well, with that, we'll go ahead and wrap it up. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.